international financial management. Today, we will discuss one of the most dramatic and insightful topics in international finance, and that is financial crisis. Now, in our previous lecture, we have discussed exchange rate regimes, the balance of payments, capital account convertibility, and we saw how Argentina's currency peg collapsed catastrophically. Today, we will take the discussion further by examining two major financial crises. First, we will look at the Mexican peso crisis of 1994-95, popularly known as Tequila crisis. Then we will study the Asian financial crisis of 1997-98, which is often regarded as the most significant emerging market crisis in modern history. These are not just historical events, they are masterclass in how financial vulnerabilities build up silently, how contagion spreads across borders, and what happens when confidence suddenly breaks. The lesson from these crises directly shaped how countries like India manage their economies today. Let us begin with Mexico. The year was 1994. Mexico was being celebrated internationally as a star reformer. It had just joined NAFTA, the biggest free trade agreement in the world at that time. Foreign investment was pouring in, growth was strong, and peso was stable. And then in December 1994, everything fell apart. Within weeks, the peso lost nearly 50% of its value. The economy went into a deep recession, and tens of millions of Mexicans saw their living standards collapse. This crisis is called the Tequila crisis, a reference to Mexico's famous drink, but also a rather grim metaphor. Just like tequila can give you a false sense of confidence before hitting you very hard, Mexico's economic boom gave investors and policymakers a false sense of security before the hangover arrived. The root cause was simply a fundamental misalignment between Mexico's fixed exchange rate policy and its underlying economic reality. Let me show you exactly how that misalignment built up. This is the timeline of the events which we are going to discuss in detail. To understand why Mexico crashed, we first need to understand why Mexico boomed first. In the late 1980s and early 1990s, Mexico undertook sweeping economic liberalization. State owned enterprises were privatized, markets were deregulated, trade barriers were dismantled, and in January 1994, Mexico signed NAFTA with the US and Canada, a signal to the whole world that Mexico was open for business. Alongside these reforms, Mexico maintained a fixed exchange rate. The peso was pegged to the US dollar. Now ask yourself, why would a country do that? Why fix the exchange rate? The answer is credibility. When the country exchange rate is fixed, foreign investors do not have to worry about currency risk or foreign exchange risk. If they invest $1 million in Mexico today, they know they can take an exact amount of dollars back tomorrow. The peg, that is the fixed rate, removes that uncertainty. And when you remove currency risk, you attract more capital. Now, it worked very well for Mexico. Mexico became a hot center for investment in 1990s, that is early 1990s. American, European and Asian capital poured into Mexican stocks, and the stocks price rised. Real estate prices also boomed. the economy grew. But now comes the critical point. This was a borrowed prosperity. The very thing that attracted the capital, which was the fixed exchange rate, was also creating conditions that would eventually make it impossible to maintain. Let me show you how exactly it did. When foreign money floods into an economy, it increases the domestic money supply. More money chasing the same amount of goods means inflation. Mexico's inflation started rising, and there is a trap. Rising inflation with fixed exchange rate means your currency is becoming progressively overvalued. Your prices are rising domestically, but your exchange rate is not adjusting. So your goods become expensive in the international terms. Suppose a product in Mexico cost 100 peso and the exchange rate was fixed to 10 pesos per dollar. Now, how much this product will cost in dollar terms? So you have 100 pesos, the exchange rate is $1 is equal to 10 peso. So it is going to cost you only $10. Now imagine inflation in Mexico increased and the price of that commodity rised from 100 peso to 150 peso. Now your exchange rate is same, that is 10 peso per dollar. Then hence this particular commodity is going to now cost you $15. The American retailer starts looking at cheaper alternatives, maybe from Bangladesh or Vietnam. Now this peg, that is the fixed exchange rate, which was the source of Mexico's attractiveness to investors, was now silently setting the stage for disaster. This is what overvaluation does to an economy. It kills export competitiveness and simultaneously it makes imports artificially cheap for Mexican consumers. Because the strong pesos let them buy more from abroad. More imports, fewer exports. This is a current account deficit. By 1994, Mexico's current account deficit had reached approximately 7% of GDP. This is a large number by any standard. It means Mexico was consuming far more from the rest of the world than it was selling to the world. And that gap needed to be financed somehow. Now there is a question every financial analyst asks when they see such a large current account deficit, that how is it being financed? What kind of capital is flowing in? If it is a long term stable FDI, productive investments, building factories and infrastructure, it is manageable. But if it is short term speculative hot money, that is very different situation. And unfortunately for Mexico, was increasingly the speculative money, what we call as hot money. To finance its current account deficit and keep attracting foreign investors, the Mexican government got creative. And as it turned out, it became dangerously creative. They issued financial instruments called Tesobonos. Now let me explain you what Tesobon is. A Tesobon is a peso denominated currency bill. Mexico borrows in peso, which is its own domestic currency. This looks very ordinary, but there is a twist. It is payable in US dollar. When the Tesobon matures, the government owes you dollars, not peso. Can you see the problem? Mexico is earning pesos from its domestic economy, but it has promised to repay dollars. This is what we call a currency mismatch. Your liabilities are in the currency that your income stream does not naturally generate. But from the investor's perspective, Tesobon was fantastic. You got Mexico's high peso interest rate but with dollar repayment protection. Why would you say no to that? Investors loved them, and huge quantities of hot money poured into Tesobons, which were short term, speculative capital, which was attracted by the combination of high returns and seemed to be very safe. Hot money, as we have discussed before, is the most dangerous kind of capital. It comes very fast and it leaves even faster at the first sign of trouble, without warning, without negotiation. You wake up one morning and the money is gone. Mexico was becoming dangerously dependent on short term capital inflow to finance a current account deficit that was widening day by day because of its overvalued exchange rate. It was a house of cards. The question was, what would knock it down? Now, let me give you the numbers because the numbers by late 1994 are genuinely alarming. Mexico's dollar denominated debt was a share of total government debt that had jumped from 6% to 50% in just a few years. Half of all government debt was effectively in dollars through a Tesobon mechanism. And the reserves? Mexican foreign exchange reserves had collapsed to just $6 billion by December 1994 because they were paying the Tesobonos at the maturity time from their reserves. Now, here is a crushing arithmetic. Mexico had $29 billion in Tesobon obligations coming due for payment, and it had only $6 billion to pay them. $6 billion to pay $29 billion of obligation. Now, there can be no clever engineering or restructuring that can make these two numbers work. Mexico was insolvent. It simply could not meet its external obligation with the resources it had. When a government reaches this point, the outcome is inevitable. The only question is whether the adjustment happens in a controlled way or in a panic. In Mexico's case, as we are about to see, it happened in a panic. In December 1994, the newly elected President Zedillo's administration decided they needed to act. They devalued peso, a modest control adjustment of 13% to 15% to correct the overvaluation and thus making their exports competitive again and restore some balance to the economy. It sounds like sensible crisis management, but in practice, it was a disaster. The moment the devaluation was announced, investors reacted not with relief but with pure panic. When they fear losses, they rush to pull out their money all at once. The massive outflow of capital caused the peso to depreciate even more further, triggering the very collapse they had feared. On December 1994, just a few days after the managed devaluation announcement, the government gave up entirely and let the peso float freely. Within days, it had lost approximately 50% of its value. Now, let us understand how it works. Let's say there is an American investor and he is investing $100 in bonds that fetch him 10% interest. Now, since this investment is in Mexico, this is going to be converted in peso. Now, here, let's say the peg is, or the fixed exchange rate is, $1 is equal to 10 peso. Now, how much he has to invest in peso? That is 100 into 10, which becomes 1000 peso. Now, this 1000 peso is going to give him an amount after 1 year. Suppose this 10% interest rate is per annum. So, it is going to give him amount 1000, which is the principal, plus 100. Now, this is the interest. This becomes 1100 peso. Now, with the same rate, if I convert it, then converting 1100 peso to dollars will give how much? 110, that is $110 to American investor after 1 year, right? This is after 1 year. Now, imagine a situation in which there is devaluation, and in devaluation, $1 becomes equal to 15 peso, right? Here when they were converting 1100 peso to dollars, so we were dividing 1100 by 10. That gave us how much? 110. Now, in this case, this 1100 peso is going to be divided by 15, which is the exchange rate, and the American investor is going to get $73.33. Now, imagine first he was getting $110 and now he is only getting $73.33 because the peso depreciated by 50%. Now, you can see even his principal has got eroded. Now, while the fundamental cause of Mexican crisis was the overvalued peso and Tesobon time bond, three additional factors made everything worse. First factors were political instability. 1994 was one of the most turbulent political years in modern Mexican history. Markets were shocked, and in March, the leading presidential candidate, Luis Donaldo Colosio, was assassinated in broad daylight at the campaign rally. Political instability and capital flight go hand in hand. When investors see political chaos, they do not want to see things develop. They just take their money and leave. Political risk compounded economic risk dramatically through 1994. In 1994, the US Federal Reserves aggressively raised interest rates from 3% to 5.5% through the year. Why does that matter for Mexico? Because when US rates rises, that is the interest rate rises, the attractiveness of emerging market investments fall. Money that was flowing to Mexico for higher returns could now earn better returns in United States, that is in dollars, with far less risk. Capital naturally started to flow back towards the US. This is an important principle. Decisions made in Washington can trigger crisis in Mexico City or in Bangkok or in New Delhi. The interconnectedness of global capital market means that monetary policy in the world's largest economy, that is US, can have a spillover effect everywhere. Students of international finance must always watch the Federal Reserve. When the investors' confidence on peso diminished, Mexico tried desperately to refinance its maturing Tesobon debt. It went to international investors and said, "Our bonds are maturing. Please roll over them. Lend us money again." And the answer was no. The confidence has evaporated. Refinancing failed completely. Mexico was now forced to buy dollars with peso to settle its Tesobon obligation at a very high rate. Buying dollars pushed the peso down further. The peso falling further made dollar obligation more expensive. Another vicious spiral. International mutual funds that had invested heavily in Mexico, billions of dollars in Mexican crisis and bonds, were now sitting on a massive losses. And in a panic, these funds did something that spread crisis far beyond Mexico. They started pulling money out of all the emerging markets, not just Mexico, all of them. The logic was, if Mexico could fail despite looking good on the surface, which other emerging market might fall next? Will it be Argentina? Or it is going to be Brazil? Or Thailand? The panic driven withdrawal from all emerging markets simultaneously is what economists call financial contagion, and this specific episode gave it a memorable name, the tequila effect. The crisis spread across Latin America. Argentina's market were hit hard. Brazil came under pressure, and even in Asia, investors who had been comfortably invested in high growth emerging markets started reassessing their exposure. Here is a critical lesson about contagion. Countries get hit not just on the basis of their own fundamentals, but on the basis of how they look to panicking investors compared to the country in crisis. If you have similar vulnerabilities, similar current account deficits, fixed exchange rates, hot money dependence, you become the next target. The tequila effect was a warning shot. 3 years later, Asia ignored it, but it had a catastrophic consequences. Just a few years after the Mexican crisis in 1997, the focus shifted to Asia, particularly to Thailand, Indonesia, South Korea, and Malaysia. For the previous decades, these countries had been growing at rates that seemed almost miraculous: 7, 8, 9, and even 10% per year. The World Bank had published a famous report in 1993 calling it is the East Asian miracle. International investors were trying hard to get money into these markets. And on the surface, there was so much to admire. Industrialization was rapid, poverty was declining, and urban middle class was emerging. Infrastructure was being built at speed. But as in Mexico, beneath this extraordinary performance, structural vulnerabilities were quietly and dangerously accumulating. Thailand, Indonesia, and South Korea were all running significant and growing current account deficits by mid 1990s. They were importing capital goods, technology, and consumer products faster than they were exporting. Isn't it familiar? These countries maintain fixed or tightly managed exchange rates pegged to the US dollar. And here is exactly the same trap as Mexico. The fixed rate created a false sense of security for borrowers. Think about a Thai property developer in 1995. He wants to borrow $50 million from an American bank to build the condominiums in Bangkok. The dollar is at 6% interest. The Thai baht equivalent is fixed and hence no currency risk. So he takes the dollar loan without buying any currency protection, no forward contracts, no currency swaps, and no hedging whatsoever. Given the information and incentives in front of the borrower, The peg had continued for years. The decision regarding raising dollar liability is very rational. The central bank had never allowed significant deviation or devaluation. Why would the borrower incur extra cost to pay for hedging a risk that appeared not to exist? Thousands of companies across Thailand, Indonesia, and South Korea made exactly the same calculation. They borrowed heavily in dollars without hedging the currency risk because the peg made that risk invisible. But here comes the point when the peg broke, when fixed exchange rate was no longer sustainable. Now, these invisible risks then exploded into very big losses overnight. Let me now zoom into Thailand specifically because Thailand was the epicenter, the place where the spark ignited. Through the early 1990s, Thailand was the hottest economy in Asia. Money was flowing in from everywhere, and much of this money was short term, speculative capital attracted by high Thai interest rates and the stability of the baht peg. The flood of hot money inflated asset prices, particularly the real estate. There was a lot of construction going on, whether it was office towers or residential apartments, shopping malls, or high rise building. Now, property prices were rising faster and faster every month, but this was a classic bubble. The property prices were being driven not by the underlying economic demand for property, but by speculative capital. Thai banks and financial companies were making this worse. They were borrowing short term from international banks in dollars and lending long term to Thai real estate developers in baht. Now, this is a double mismatch. One, the currency mismatch, and second, the maturity mismatch. The property bubble showed a sign of deflating because too much construction had taken place. Developers had built large number of office buildings, hotels, residential apartments and shopping centers based on the assumption that demand would keep rising. However, by 1996, export growth had slowed and the economy was weakening. Income and business activity slowed down, and what happened? The new demand for new property also reduced. Many buildings remained unsold or vacant. Property prices stopped rising, and investors became less willing to lend to real estate projects. Once people realized that property prices would not keep increasingly indefinitely, the speculative buying also slowed down. As a result, the bubble began to deflate. The baht appeared overvalued, the current account deficit was large, the central bank reserves were limited, and the fixed exchange rate looked increasingly vulnerable. Speculators believed that the Thai government would not be able to maintain the peg. This large scale selling of baht created a downward pressure on the currency. As more and more investors sold baht and demanded dollars, the Thai central bank intervened to defend the fixed exchange rate. It used its foreign exchange rate reserve, mainly US dollar, to buy back baht in the market and support its value. However, the pressure continued for months. The more investors feared devaluation, the more they rushed to exit, forcing the central bank to spend even more reserves. Eventually, Thailand no longer had enough dollars left to keep defending the peg. Once the reserves were exhausted, it had no choice but to float the baht. Now, I want to pause here and go deeper. Because if we only talk about exchange rates and hot money, we will miss something very fundamental about why the Asian crisis was so severe. Beneath the macroeconomic vulnerabilities, there was a deep structural problem in many Asian economies. Economists call it crony capitalism. Now, what does crony capitalism means? It means that business success depends not only on merit, productivity, or innovation, but on political connections and favoritism. Who you know matters more than what your business can actually do. In several Asian economies, this was deeply embedded. Banks extended credit not based on the credit worthiness of the borrowers, but based on the political relationship. A businessman with connections to senior government officials could borrow hundreds of millions of dollars for projects that would never generate adequate returns. The banks lent because it had to, not because the economics made sense. Now ask yourself, what does this do to a capital allocation in an economy? Capital stops going to the most productive uses and starts going to politically favored uses. Real estate projects that could never be profitable, manufacturing plants, and politically connected business that survived only because they kept receiving a constant flow of new credit, new borrowing. This explains why asset bubbles were so much worse in Asia. The market's normal corrective mechanism is that the unprofitable business lose access to capital. Now, this whole mechanism of unprofitable business lose access to capital was disabled by crony capitalism. The financial sector was underregulated and over leveraged. Corporate governance was weak. Risk assessment was corrupted by political consideration. When the crisis hit, this is why the damage was so deep and so wide. The crisis didn't just reveal bad debts, it revealed that its entire economic system had been built on the foundation that was far weaker than anyone had admitted. Once the bath collapsed on July 2, 1997, the crisis sped with a speed that shocked even experienced crisis economists. First, Asian corporations have borrowed heavily in US dollar with no hedging. They assumed the peg would hold. Now then what happens? The peg breaks. Now fixed exchange rate system is no more sustainable. The local currency loses. Let's say it loses 30% of its value overnight. Now look at the dollar debt. A company that borrowed $100 million when the exchange rate was 25 baht per dollar owed just 2.5 billion baht. After the baht drops to 35 per dollar, that same $100 million debt, which was earlier 2.5 billion baht, now cost 3.5 billion baht. Now it's a 40% increase in local currency terms with no new borrowing options. Companies that were marginally viable are now insolvent. That lent to them now have non performing loans. Banks start to look shaky. Investors see the insolvencies and the banking stress. They lose confidence, they pull capital out. Capital outflows put further pressure on the currency, it depreciates further. The dollar debt is now even more expensive, more insolvencies, more capital flight, more depreciation. Now, this is the spiral. Each turn makes the next turn worse. Each depreciation creates more insolvencies. Each insolvency triggers more capital flights, and each capital outflow causes more depreciation. This is why emerging market currency crisis moves so much faster and hits so much harder that anyone can anticipate. The interconnection between currency, debt, and confidence creates a dynamic that can take a seemingly stable country from health to collapse in a matter of weeks. Thailand, Indonesia, South Korea, all of them experienced this spiral. Let me take you through Indonesia in details because Indonesia experiences perhaps the single most dramatic illustration of how fast and how deep a financial crisis can strike. This was the series of events which we will discuss further. As of June 1997, just weeks before the crisis reached Indonesia, here is what the data showed. Indonesia had low inflation and it was controlled. Trade balance had a surplus of over $900 million. Indonesia was actually exporting more than it was importing. Foreign exchange reserves were over $20 billion, substantial by standard, and banking sectors were appearing sound on official assessment. If you had been an international economist looking at Indonesia in June 1997, you would have said that it is a well managed economy. It is vulnerable to some regional contagion, but its fundamental are reasonably strong. But beneath the surface, Indonesian corporation had been borrowing massively in dollars. The crony capitalism we discussed was too much, especially in sectors connecting to some political families, and crucially, it very little of this dollar debt was hedged. When Thailand floated the baht in 1997, investors began reassessing Indonesia as well. Thailand crisis made investors fear that other Asian currencies might also be overvalued and vulnerable. Investors noticed that many Indonesian companies had borrowed heavily in US dollar, and if the rupiah depreciated, these firms would struggle to repay their debts. As confidence weakened, investors started pulling money out of Indonesia and selling rupiah for dollars. Indonesia's central bank responded by expanding rupiah trading band from 8% to 12%, trying to show markets that it had flexibility without fully abandoning the peg. But still, capital outflow began and it increased immediately. On August 14, 1997, just 6 weeks after Thailand, Indonesia had to abandon the managed exchange rate entirely. The rupiah was allowed to float freely. Now, I want you to pay very close attention to these numbers because they are extraordinary. Before the crisis, the rupiah was trading at approximately 2,600 rupiah per US dollar, a reasonable stable rate for a developing economy. By January 1998, just 5 months later, the rupiah collapsed to 11,000 rupiah per dollar. At its worst point, the rate reached 14,000 rupiah per dollar. Now, let me make you understand what this means. The rupiah lost approximately 80% to 85% of its value in 5 months. An Indonesian company had borrowed, let's say, a huge amount of money in dollars. Now, this particular repayment will also require more rupiah, maybe a lot of times more, to repay. The debt was so high in local currency terms that, and it became high overnight with no warning. Now, corporation went bankrupt in waves, banks collapsed, unemployment soared, inflation hit over 75% annually in 1998 as the collapse of the rupiah made every imported goods, whether it is oil, food, medicine, and machinery parts, enormously expensive. And then the crisis moved beyond economics. President Suharto, who had ruled Indonesia for over 30 years, was forced to resign in May 1998 as the economic collapsed, triggered massive social unrest, riots, and political upheaval. A financial crisis now had become a political revolution. The lesson is very important. Even a country with a reasonable sound macroeconomic indicators can be devastated if it has the wrong exchange rate regime, the wrong debt structure, and institutional vulnerabilities that only become visible when the pressure is on. Indonesia is the most extreme case, but the same dynamics played out across the region. Now, here is a contrast that I find genuinely fascinating, and I want you to think about it carefully. Right in the middle of this regional catastrophe, currencies collapsing from Bangkok to Jakarta to Seoul, China was unaffected. The Chinese yuan remained stable. China's economy continued growing. Why? What did China do differently? The answer comes down to a single strategic choice. China favored FDI over portfolio investment. While Thailand and Indonesia were attracting enormous quantities of short term speculative hot money, portfolio flows, bank loans, currency carry trades, China was channeling foreign investment primarily into tangible, productive assets, which are factories, manufacturing plants, infrastructure, physical productive capacity. These are what economists called sticky assets. A factory built in any China city cannot be liquidated and repatriated to New York when the crisis hits. The capital is physically embedded in the China's economy. A speculative fund manager cannot press a button and take a factory out of China. Short term portfolio capital, by contrast, can exit within hours. With sentiments turns, a fund manager can sell his Thai baht bonds before breakfast, his Indonesian rupiah position before lunch, and his Korean one before dinner. This is what exactly happened in 1997. China had structured its capital inflows so that the kind of sudden stop that devastated its neighbors simply could not happen. The capital was sticky, the crisis could not get into traction. Let us now look squarely on at what the crisis did. The impacts operated in four levels. Indonesia's GDP contracted by 13%, Thailand by 10%, and South Korea by 7%. For context, the United States contracted by about 4% during 2008 global financial crisis, and this was considered a historic catastrophe. What Indonesia experienced in 1998 was more than 3 times worse. Unemployment in Indonesia alone rose from under 5% to nearly 20%. Millions of people who had just entered the middle class were pushed back into the poverty almost overnight. The IMF assembled emergency rescue packages, over $100 billion in total, for Thailand, Indonesia, and South Korea. This was the largest international rescue operation in history at that time. But the IMF attached strict conditions. Countries had to raise interest rates, cut government spending, close weak banks, and implement structural reforms. As per the theory, high rates would attract capital back, spending cuts would restore fiscal discipline. Across the crisis countries, the banking sector was devastated. Hidden bad loans, the legacy of years of crony capitalism and connected lending, was suddenly exposed. Hundreds of financial institutions were closed, merged, or nationalized. Governments had to use public money to recapitalize banks, essentially paying for the consequences of private sector recklessness. Meaningful reforms emerged out of such devastation. Exchange rate regimes were made more flexible, banking regulations were dramatically strengthened, corporate governance standards was raised, and most significantly for our subject, foreign exchange reserves were built up massively across Asia as a buffer against future crises. Every crisis we studied today was the result of vulnerabilities that had been building for years: overvalued currencies, currency mismatches, hot money dependence, institutional weaknesses, all accumulating silently beneath the surface of apparent prosperity. In our next lecture, we will move to Eurozone crisis, and also we will learn the lessons from the various crises. Thank you.